Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. Now, despite a series of assurances, the Indian stock markets continue to grapple with the impact of the global markets crash, triggered by the crash of Chinese stocks as well as the devaluation of the yuan. Even the government of India accepting a report that minimum alternate tax or MAT will not be levied as there was no legal basis for collecting the tax before April 2015 has had very little impact. Here's a report.
India's stock markets continued a declining trend this week as well. On Friday, the benchmark BSE Sensex touched its lowest in 14 months, a dip of 4.25% over 5 days of trading. The NSE Nifty also fell over 4% this week. Time for urgent corrective measures. The government announced that it would not levy a 20% minimum alternate tax or MAT retrospectively on capital gains made by foreign investors.
We would be bringing out that amendment in the statute. Meanwhile, pending such an amendment, all the field formations will be conveyed by way of a circular that this is the decision of the government, so they'll have to hold their hands and not pass any further orders in these matters.
There's no doubting the importance of foreign investors for India. They invested over 64,000 crore rupees as portfolio investments in 2015. Their withdrawal from emerging markets after Chinese stocks crashed in June-July sent the markets into a tailspin. Foreign investors sold shares worth over 17,000 crore rupees in August and shares worth over 2,200 crores in the first 2 days of September alone. As a result, both BSE Sensex and NSE Nifty have registered a decline of over 8% in the last month.
In the absence of any positive trigger, there is a huge unwinding happening. The foreign investors, they are getting a little disenchanted with the market.
It's not just India. Across emerging markets, foreign investors are pulling out. Investment firm Jefferies says investors pulled out funds worth $4.4 billion. $11 billion were invested in markets in the US and Europe. Markets are expected to be volatile for some time as the US Fed is expected to announce its monetary policy this month. The possibility of an interest rate hike by the US Fed is attracting investors to developed markets. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, where indeed will the markets go? Joining me now, Ambareesh, Baliga market expert, and Murthy Nagarajan of Quantum AMC. Gentlemen, thank you very much for joining us. So, the MAT was supposed to be at least the temporary bullet or the silver bullet, but that didn't happen. Why is that, Ambareesh?
No, that's because clearly, I mean, if you need to give the medicine, you need to give it at the right time.
Okay.
And this time was possibly about 6 months back when the initial issue had started and the FIR had started selling. That was the time I think they should have come out with a clarification. But then, unfortunately, nothing happened, and now it's come so late when the markets have started, cracking majorly. In fact, there's panic in the markets in the last couple of days we have seen. At the same time, when FIs have sold out in such a big way, there's no point talking about it right now and coming out with the clarification.
Right. So you're saying in some ways the FIs couldn't care whether this happens now or it doesn't happen. Absolutely. Because in any case they're exiting for other reasons.
Yes, absolutely.
Right. So is that a good thing then, Murthy?
Yeah, on valuation perspective, it is becoming more and more attractive for people who want to enter now. This is a good time. People who have missed out on that opportunity, these levels look decent. Like we in Quantum, we feel that this is for a long-term investor, these are all good levels for people to invest right now. So from the frothy market which was prevailing before last 6 months to 1 year, and now the market has corrected, valuations have corrected, and it has come at level which are reasonable.
Right.
There could be some more downside correction, but these should be used as an opportunity to buy only.
Right. So you're saying the values are good. Ambareesh, let me come back. So let's put aside MAT for a moment. But what's really happening? Why are we seeing such strong outflows? If we were to just revisit some of the key 2 or 3 reasons for driving the markets and their behavior at this point.
See, I think the panic actually started with the China slowdown,
right,
and then the devaluation, which affected the other currencies, including ours. Then there's a fear of a Fed rate hike, which again should be negative for the Indian markets, at least in the short to medium term. But then I think the question to be asked right now is about the India story. We were quite gung-ho about the India story in the last 14 to 16 months, especially post Modi's election. I mean, has that changed? And I think the other thing which should be asked is, do you still believe that this government will deliver or not? If your answers to both these questions are on the negative, saying that yes, the government will deliver, and I believe in the India story, then I don't see any reason as to why you should not go out and buy now, when there's a huge a discount sale happening.
Right.
People were extremely positive about a month back.
Has lost almost 10%. Right,
Absolutely,
since the fall, yeah.
Absolutely. If you look at the Nifty, it was about 8,500. Now we are closer to 7,600. So if you don't buy now, when will you buy?
But there's a but, right? You're saying that this depends on whether your prediction or your bet is on things in the domestic economy really looking up or not.
Absolutely.
Yeah.
If you the thing is, if you don't believe in it, then you should be like exiting the markets and possibly exiting India.
Okay.
But then if you believe in it, this is the best time to start investing.
Okay, so let me put the question differently, Murthy. So I know that you said you believe in this, but that's a slightly more medium to long term perspective. How do things look in the short term?
It's very difficult to predict markets in the short term, because what happened was that the people could not predict the Chinese currency devaluation, and this actually led to people selling off in this market, because global markets have sold off. So we are in tandem with global markets that people are selling off. The fear is that whatever is the fear, I think it's slightly aggravated as far as the Fed is concerned, because even if you look at the 1 year futures, you are not looking at a Fed hiking by more than 50 to 75 basis points. Given the situation that it has been a most talked of story in the market,
it's already priced in to some extent.
It should be already priced in. My feeling is that if they are looking at a hike, then definitely at least the Fed is confident that the US economy will do well.
Right.
And historically what we have seen is that whenever the US market does well, our market does well. Whenever the dollar becomes strong, our currency also becomes strong, which is right. Contrary to what we have been.
So explain to me just very quickly. So while the week seems to have closed somewhat weakly and more than 560 points down, and yet we saw an upswing during the week, right? So we saw things going up and again going down and again going up. So what explains that? Is there fundamental uncertainty? Are there still some people who are bullish and therefore not being sort of able to come in strongly?
Actually, it has got more to do with what is now happening is that people are just trading on data. One data point comes where people feel that okay, it's good, so people take it up, and then you got the Fed. Actually, many people are expecting that the ECB will do something. The ECB just says that 25% government securities they were buying, now they are going to buy 33%. That has not interested the market. So we saw markets falling there. So
right.
In tandem, we have fallen today.
Right.
So this is actually, these are all
reacting
noise.
to one data point at a time. Ambareesh, is that your position as well?
Like to a certain extent, there's a huge difference between what had happened in 2008 and what's happening now. 2008, we were heavily leveraged. There was not much of domestic money coming in. Right now, we are not really leveraged as such, and there's a huge amount of domestic liquidity which has flown into the markets, and which is again long term. This is not retail investing directly in the markets, it is via the mutual fund, via SIP. So this is long term money which is coming in, which is actually balancing out the FI outflow. But still that effect is there, because of which we have seen the markets cracking.
So I'm trying to understand what's explaining this sort of dramatic swings in the last week or so.
No, swings are, you normally.
Or you're saying it's a data point effect?
See, it's just not like a data point effect. Whenever you have seen the markets cracking majorly, you normally have people coming in to buy,
right.
because of which you see that bounce back.
Right. Okay, great. So let's take a forward kind of view then. Right. So how are things going to likely to pan out in coming weeks?
Quite difficult to say, but then I think the next couple of weeks would be painful. We could see a lot of volatility. We could possibly see the markets still heading a bit lower than where we are right now. But like I said, it is a buying opportunity. And again, if you believe in the India story, I think we are in an extremely sweet spot. Oil is majorly down, commodities are down. We should be
but all of which also reflect a weakening global market, don't they?
No, that's true. But then, end of the day, here, once the infra prices take off, once you have capacity building up happening in the, like in your industries, you will be a big consumer. India will be a huge consumer of these goods, and we'll be getting it much cheaper than what possibly we would have got about a year back. Right. So that's the reason I'm saying we are in an extremely sweet spot.
Right. Okay. So Murthy, if I were to ask you for 2 or 3 reasons that will drive markets up and what could keep them down, what would they be?
One is that, okay, like if you look at how the commodities as well as oil has actually played out, we should say around 50 to 60 billion just on the oil side. Then a subsidy bill will come down because now the under recovery has actually come down. Kerosene is now around 13 rupees and we have got some 150 or 157 rupees on LPG.
Right. So your macros are improving.
Macros are improving big way, and their current account deficit should be around 20, which could definitely be funded by. We don't require FII flows also. We just require this foreign direct investment, which was 34 billion last year. Even if you get that same amount, your current account will be easily be financed. So, which is good for us. And India being a net importer of commodities, we should benefit. Right now, what is happening is that globally, we are seeing the countries which are getting battered are Brazil, major exporter of commodities. Australia, the currency is down by 20%. The Indian currency is down hardly by around 3-4%. The Chinese currency is down by 2.6 now. So, given that situation, macro-wise, we are much better compared with global markets.
Right.
One of the reasons which we are hearing the marketplace is that FII seems to have a lot of profits here in this market compared with other markets.
Right. So they're taking it out.
So they are taking it out.
So these are some of the reasons why we are batting on a safe wicket, you could say. But what is the downsides?
Downside is, let's say you get, let's say that commodity prices again flare up. Like we saw in the last 3 days, we saw almost oil going up by almost $10. If that type of thing happens, which is a low probability event, then it could be a problem.
Right. But there's also a general wait for the India story to improve. Am I right, Ambareesh?
Yeah, that's true. Because we should have seen things happening at the ground level even about 6-7 months back. But that's not happening.
Like we should have seen the MAT come in at least to assuage
absolutely,
some.
Absolutely. So I think we have that window of the next 2 or 3 months, and if we miss that, then I think just like how the UPA government missed out that sweet spot in 2009, I think this government would have missed out on that spot.
Right.
In the next couple of months. In case in the next 2 or 3 months, if things don't take off, then I think possibly, I mean, we could have lost the story.
Right. So last question. So what are the kind of sectors that are holding up in this market despite everything else?
No, whenever
and thus reflecting maybe the underlying strengths of the economy.
See, I mean, whenever you have, you have the markets cracking, the only sectors which actually hold on are the defensive ones: IT, pharma, FMCG to a certain extent. But if you ask me, I mean, would I invest there? Surely not. I would possibly look at the India building story, which is infrastructure, capital goods, banks, especially the ones which have fallen majorly, autos, cement, metals, which have again cracked. I think this is where you should be investing at this point of time for that major pullback.
Okay. Murthy, your picks broadly?
Our feeling is people should. We are actually invested more in consumer discretionary because we think these are all, it offers deep value right now, and the banking space, especially on the PS, many of these banks are trading at decent valuations right now. There could be valuation trap also, but and some of the banks are good. So these are the banks where if you hold on, you should make a decent return over a longer period of time.
Okay, good. So long term, both looking this thing, keep invested in the India story. That's the takeaway here. Thank you so much. We need to go in for a break. Coming up about the other side, GDP numbers have been weak, and plus the monsoon has not really delivered. We'll talk about that with DK Joshi, Chief Economist of CRISIL, and Shubhada Rao, Chief Economist of Yes Bank. Stay with us. Welcome back to Policy Watch. The economy grew just 7% in the April to June quarter of 2015, a decline over the same period last year. Now, the dip has been blamed largely on a fall in agriculture, manufacturing and services performing worse than expected. A weak monsoon could make it worse. Here's a report.
Just 7% growth in the first quarter of 2014-15, casting strong question marks against the 8.5% growth target for the full fiscal. The government, though, insists all still on track.
If the GDP numbers are kind of reassessed along the lines I'm suggesting, that we would still stick to our prediction that we'd be closer to 8 than currently being forecast.
Growth in agriculture, forestry and fishing declined to 1.9% from 2.6% for the same period last year. In the manufacturing sector, it declined from 8.4 to 7.2%. More worrisome is the nearly 6% decline in private sector manufacturing that accounts for nearly 2/3 of total manufacturing in the country. Growth rate in electricity production measured as IIP data fell an astounding 9% during the same period. Economists say reversing the cycle calls for a big increase in public expenditure.
That will generate, say, a demand for steel, for cement, maybe for many other commodities. And if there, so there is a, multiplier effect which will get generated from there, and then maybe other, sectors would also feel the impulse, and then maybe the cycle will pick up.
An abnormal monsoon deficient in central and southern India and excessive in northeastern parts poses another big challenge for revival of the economy. But there is a silver lining. Both wholesale and retail price rates are at a record low, and that could result in an interest rate cut in the RBI monetary policy announcement due at the end of September. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, joining me now to discuss the impact of slowing GDP numbers as well as the monsoon impact is DK Joshi, Chief Economist of CRISIL, and Shubhada Rao, Chief Economist at Yes Bank. Thank you both for joining me. DK Joshi, let me begin with you. Before I try and understand how bad it could get, where exactly do we stand now? Do we know exactly how things are panning out when it comes to the broad economic numbers?
Well, I think there is a general consensus that things are very gradually improving. It's a mixed picture. I think where we see clear improvement is industrial production. I think industrial production was at 1% per year growth for almost 3 years, and I think for the last 6 months it's been over 3%. So this is the first patch where we have seen industrial production doing well. But on the other hand, the exports are not doing well at all. There is some positive kick to the economy expected from government, where it is pushing investments in infrastructure segments like roads, etc. So I think there's some. It's a mixed picture. I mean, inflation is there's good news on the inflation front, on the current account deficit front. I think they are very much within control. But I think the problem. The major problem is in revival of private investments, because the private sector, we believe, is not going to increase its investments at least in 2015-16, because the utilization of capacity is very weak, very low. So we don't see a meaningful recovery in investment cycle until 2016-17. So I think it's a mixed picture. I mean, some things look slightly better, other things still look down. And the banking sector, to add to the negative news, the banking sector still continues to be straddled with weak assets which are going to grow this year, and the NPAs, CRISIL expects them to rise to a little over 4.5% by March 2016. So as I said, a mixed bag, but a very gradual recovery, very gradual grind up underway.
Okay, so you talked about a gradual recovery and a mixed bag, DK. So let me come to Shubhada. Shubhada, the fact is that GDP growth numbers have slowed down. Moody's reduced its outlook as well and cut the GDP projection from 7.5 to 7%. So what does this really mean then? Are we expecting too much or anticipating too far ahead?
No, I think right from the beginning, Govind, we were anticipating only a gradual recovery, despite three of the factors coming in well and supportive of growth in the current fiscal year, those being the significant support from commodity price crash, interest rate environment getting benign, and also the policy environment getting slightly better than what it was a couple of years ago. So these three factors should have been supporting growth in a significant manner. But the reason why we did not believe that they would eventually translate into headline numbers were two factors. One, the uncertainty around monsoon, which would continue to dampen the rural demand outlook. Though I believe that on consumption front, to some extent, urban demand has held up. If we look at the high frequency lead indicators supportive of urban demand, be it on credit card outstandings and receivables, or you look at the higher end auto segment sales and production, or within services, if you look at airport, volumes. I think all of these seem to be suggesting that there is some traction in urban demand, but rural demand is clearly weak. weak and likely to remain weak if monsoon deficiency further worsens. Now, as far as capital formation is concerned, we believe that, and we had right along believed that there would not be private sector appetite in the current fiscal year at least, purely because there are issues on the corporate sector balance sheets. You do not have a very strong global, you have a weak global supportive environment to push for export demand to come through, and therefore, it was all lying on the shoulders of the government to kickstart the capex cycle, which we believe in at least the first 4 months of data, Govind, on the fisc, we believe the government is actually walking the talk. There are a lot of ministries where we have seen plan expenditures significantly, ramp up, be it on, the renewable energy, which is a brand new story for the current fiscal year, but even in nuclear energy, other power sector, roads, as DK was mentioning.
Can I just interrupt you there for a moment? Let me come back on that in a little bit in terms of what the outlook is. But DK, you had clearly projected that a bad monsoon would mean a 0.5% reduction in GDP growth and a good one would mean an addition. And do correct me if I am wrong there. But now we are looking at a situation where GDP growth has already slowed down and we are now trying to understand what the impact of a weak monsoon could be. So walk us through those numbers.
Well, I think when we said that GDP will reduce by 5 basis point, or 5 percentage points, or to be precise, I think we already built it into our outlook. I mean, we cut our outlook from 7.9 to 7.4%. And I think currently we are working with a GDP growth of 1.5% in agriculture, which is subpar because last year agriculture hardly grew. So it is hardly any growth, and it's a weak monsoon that is factored into our forecast already. And I think we do believe that that industrial sector will look up a little bit, and I think agriculture is more likely to underperform, though I think there is some good news on the distributional fronts, because the northwestern part of India, which contributes about 46% to the total food grain production, I think that is more or less okay. But there are specific pockets where you will see stress. I think particularly the pulses, the oil seeds, and also I think the coarse cereals. I think these are the sectors, these are the crops which will be under stress. But overall, I think the economy, we still believe, should hold up at around 7.4%, which, by the way, is hardly any growth over last year. Last fiscal, the GDP growth was 7.3%, and only a 10 basis point increase over that is being projected. That's hardly any upward movement.
Both of you are obviously talking about a delay in the capital investment revival. You're also talking about a mixed bag in general, though things are happening in terms of projects, particularly public funded projects. So let's try and understand what could happen in the next quarter or forward. Shubhada, let me begin with you. So what's your sense? If we have already seen a reduction in GDP growth numbers this quarter, and we are saying that there could be a monsoon impact of some sort, even if it is diminished, as DK says, an impact nevertheless, what could be the combined effect given everything else that we are looking at, which is a sort of slowing global economy, the whole problem about rupee depreciation and its sort of attendant impact?
Sure. I think we are looking at, just as I said earlier, just 50 basis point. We are slightly, more bullish in terms of our growth as compared to DK's numbers of 7.4. We are at a 7.8% growth, and the reason being, Govind, is services are not doing that badly. If you look at trade, hotels, transport, communication as a basket, and if you look at finance, yes, deposit and credit growth have lagged. But things like insurance and so on have done better. In fact, the whole segment coming in at a slightly higher number than our anticipated number in the first quarter was a positive upside. So I think this 50 basis point increment that we see would be essentially getting supported through broader segments of services. Agriculture, no doubt, as DK was saying, is a concern. But to my mind, agriculture's share in GDP being at 17% now would have relatively a slightly lesser negative impact on the headline GDP. Had it been services, that those were, somewhere perhaps on a serious
correctly,
downside.
You're betting entirely on services to bring back this number. I mean, 7.8, of course, is close to what the Chief Economic Advisor Arvind Subramaniam has said of 8% by March 2016.
I think it's to some extent, as I said, services. But as I was talking earlier about the government's role in capital formation, I think we cannot deny that government has actually begun to invest significantly in its capex plan. And that in turn should get supportive in the third and the fourth quarter to revive manufacturing sector. No doubt private sector greenfield investments will be a not. But I think government pump priming, which we talk in economics, is something that's going to help, and we believe that those numbers should begin to reflect in manufacturing sector growth in the third and the fourth quarter. We are seeing some green shoots, we are seeing some pockets of growth. I think those should get galvanized. Of course, we have a renewed intensity of global uncertainty, but probably this is the time to look even more aggressively inward than outward for looking for growth impetus and drivers.
So, DK, let me come back to you. So, if we are at 7% today, what is it going to take us to, if we, push, accelerate from beyond what we were originally supposed to be, cross that mark and then go to, let's say, a potential 8% mark, which the government is targeting?
Well, I think you can achieve 8% in a particular year, but I think the issue is whether you can sustain 8% year on year, maybe for the next 5 years. I think for that, pushing reforms and making sure that the ease of doing business which government is trying to push, actually there is they walk the talk on that. I think without that, I think sustaining 8% in this kind of global environment, I think just on the basis of domestic push is going to be very difficult.
Right. So, and Shubhada, are you in concurrence with that, or would you disagree?
No, I would think that if we get our house in not necessarily in good order, but a healthier order, I would think. If we have.
You're also talking about half a year now left.
No, I'm talking of half a year and beyond. As I said, we are looking at only 50 basis point improvement in GDP in the current fiscal year over the last year. From 7.3, we are looking at just 7.8, which is not a great number, if you compare our own potential to grow. So clearly, I'm looking beyond this current fiscal also. If we get 2 or 3 critical reforms, under our belt, I would think the prospects for India's growth would only get better, because some of the DMs are really doing well. It's definitely the, related issues around the emerging markets, the BRICS nations. And there I feel in comparison, India stands far better, and that you can see in most of the financial market indicators, be it equity, be it currency depreciation, etc., or bond market yields.
Shubhada, so what is the one positive thing that you're looking out for, and what's the one downside or the negative thing that we should be concerned about going ahead?
I think 2 critical things, Govind, would be, one is very clearly the GST. That we hope that sees a light of the day in the very near term. And second would be, if land acquisition is going to be an issue at a nationwide level to be called into a successful act, then something like a replicating of Andhra Pradesh model of land pooling. Why not accept and multiply the best practices of some of the states, and those, if they're able to resolve the various interests of the stakeholders.
Shubhada, I'll have to interrupt you there. Let me, we're running out of time. Let me get a quick 10-second in from DK. DK, you're the one concern point and the one point that you would perhaps say is a positive.
Well, I think one concern for me is the non-passage of the GST and uncertainty surrounding that. And the positive thing is that the global crude prices and commodity prices have come down further, and that's going to help us keep current account deficit, fiscal deficit, and inflation under control.
So let's see and hope we hit that 8%, which of course requires a lot of things to be moving at the same time, but it might, as both our panelists seem to say. We've run out of time. Thank you very much for joining us today on Policy Watch. We'll be back next week, same time. Thanks for watching.